All right. I promised you at the beginning that we're going to talk a little bit about spending in retirement. And I think this is an important topic to understand. The truth is that many doctors dream of retiring from the workplace before that traditional retirement age of whatever it is, 60 to 70, somewhere in there. Most docs can't do it though. Why can't they? Three reasons. They spend too much, they didn't save enough, and they didn't invest wisely. They simply don't have the resources to retire at the time they desire to retire. So they end up working an extra few years. Now, it's not the end of the world, right? Life isn't all about money. It's not all about retiring as quickly as you can or having, the biggest nest egg in the graveyard for sure. But paying some attention early on in your career, like our guest today, can facilitate this as at least being an option for you. Whether you just want to cut back and be a part-time doc like I am, and like I suspect Dusty will be in just a few years, or whether you want to retire completely, you got to have the money to do it. A lot of people just have to wait until they have more savings, until compound interest can do more magic on their nest egg, until they start getting some Social Security money. And that's fine. But if you want to retire early, you got to spend a little more time thinking about how to spend in retirement, especially those first few years. People worry about this age 59 and a half rule, right? You basically can't get into your retirement accounts, at least your IRAs, till age 59 and a half. Or you'll have to pay not only taxes that are due, but penalties, a 10% penalty. That rule is actually age 55 if it's a 401k and you've separated from the employer. So that's the first way you can get into your money earlier is don't roll it into an IRA. Leave it in the 401k, and then you can spend it at 55 without any penalties. So that's kind of cool. Don't forget about that if you're thinking about, retirement date earlier than 59 and a half. Other great options for that time period. The truth is most people who have enough to retire early, if you have enough money to retire before age 59 and a half, you almost surely have a taxable account, right? Because you just haven't been able to stuff enough into your retirement accounts in order to retire early. So that's what you spend first, right? You get into that taxable account and, you spend the high basis stuff first so it doesn't cost you much in taxes. And then eventually you may end up spending the low basis stuff as well before getting into your retirement accounts, especially if you're still at an age where you have to pay a penalty to do it. Don't forget there's also lots of exceptions to that age 59 and a half rule. One exception is a 457 plan, right? This rule does not apply to 457s. These 457Bs are deferred compensation plans that lots of employers, particularly academic employers, often offer. Depending on the plan provisions, you can often get into that as soon as you retire. And so that's what lots of people do to cover years from 50 or 55 to 59 is they use their 457 money. So people are living off their taxable money. They're living off their 457 money. Don't forget there are other exceptions for that age 59 and a half rule as well. For example, you can take money out to pay health insurance premiums for a first home for you or your kids. If you're disabled, obviously, if you die, you can get into there earlier. There's some new exceptions that came up with the Secure Act 2.0. For example, if you've been the victim of domestic abuse, you can get to some of that money penalty free. So lots of options there. Roth IRA principal, you can get to before age 59 and a half. There's also this cool exception they call the 72T exception or the SEP exception, SEPP, substantially equal periodic payments. This is basically the early retirement exception. If you retire early, you can get to your retirement accounts without paying penalties. You just have to take out only a reasonable amount each year, and it works out to be 3 or 4%, which is about what you want to take out anyway, if you want that money to last. So that works just fine. So that's how you get to your money before age 59 and a half without paying that penalty. And it's not the end of the world if you do have to pay a little bit of that 10% penalty on some of your retirement money, because chances are, if that's the case, you're probably paying at a much lower rate, even including the penalty, than when you put the money into the account. Other things you can raid, health savings accounts, right? For health and medical expenses, you can take money out of there anytime, penalty and tax free. If you've been saving receipts for prior medical expenditures, you can take that money out and spend it on anything and just put it up against those prior receipts that you have. Again, tax and penalty free. But you don't really want to raid that for non-medical expenses ever if you can avoid it, but certainly not before age 65, because then you got to pay a penalty. It's not a 59 and a half rule with an HSA. It's a 65 rule. So keep that in mind. Now, once you're kind of past these penalties that you got to worry about for early withdrawal from retirement accounts, you should also think about, how do I want to spend this money? And there's this dogma out there, and I don't know how it got started because it's not always true. But the dogma was basically spend taxable first, and then spend tax deferred, and then spend tax free money. That's not the case. I mean, as a general rule, yes, you generally want to spend taxable money before retirement account money, but that's not always the case. If it's very low basis money, especially if you're going to be dying soon and your heirs would get a step up in basis on that money, you may not want to spend that before retirement account money. And then, of course, when you're talking about tax deferred and tax free money, you can adjust how much you take from each of those accounts and basically set your own tax rate. And it's unlikely that the most efficient way to do that is take all the tax deferred money before taking any of the tax free money. A combination is probably the right way to go. You take the tax deferred money up to the top of whatever bracket you're in, and then tax free money above and beyond that. That's probably a more tax efficient approach to take to spending your money in retirement. Now, you might have some other assets out there that are available to you. Maybe you have some home equity. Typically, that's something you tap pretty late if you need to at all. Likewise, if you, for whatever reason, ended up buying a cash value life insurance policy, like a whole life policy, that's generally something you want to take relatively late. The best use for that is to leave it to your heirs. And so if you don't need it, that's one of the last things you'll leave. It goes to them, totally tax free, because that's the way death benefits are. Just like your taxable account goes to them tax free, of course, thanks to the step up in basis at death. You also want to keep your estate planning desires in mind, right? If you're planning to leave a whole bunch of money behind to charity, I mean, you preferentially want to leave them HSA money and tax deferred money, because they don't pay taxes on any of that. So you won't pay taxes, they won't pay taxes. You can make a big difference there. And if that were the case, you might spend your tax free money preferentially, because it'll lower the overall tax burden paid. On the other hand, if you're planning on leaving all your money to your kid, and your kid's even more financially successful than you are, they'll certainly appreciate inheriting the tax-free money, the Roth IRA kind of money. So you may want to spend that last in order to leave more of that to them, and live on your taxable and tax-deferred assets, during your lifetime. So estate planning certainly plays into it as well. Be careful with people who are dogmatic and telling you exactly the order you must spend in. It's really a year-to-year decision, looking at your tax bill and deciding where to pull the money from. I hope that's helpful in understanding how to spend in retirement. The other thing to talk about, I suppose, is how much to spend in retirement. And the general rule there is, again, don't get dogmatic. Start with something like 4% of your nest egg and adjust as you go. If a really bad sequence of returns, crummy returns show up in your first few years of retirement, you might want to dial it back a little bit. Maybe only sending 3% or 3.5%, certainly not more than 4%. If it doesn't show up, you can spend a little bit more than 4%. And certainly if you're now 85 or 90 years old, you don't have to hold yourself to the 4% rule. You're not immortal, right? Spend a little bit more. It's not a bad idea. One plan some people do is they just spend their entire required minimum distribution, and that percentage goes up over time. It starts at about 4% at age 75. By the time you're 92 or something, it's like 12% a year. It's okay to spend that much. If you're spending about what an RMD would have you spend, that's actuarially pretty sound and not a bad way to decide how much to spend each year in retirement. The truth is, most people die with more than they retired with, because they just don't spend. People that have been good savers, they don't spend that much in retirement. They're worried they're going to live to be 105, and really they only live to be 85 on average, or 83 on average. And their nest egg continues to grow throughout retirement. That's certainly what's been happening to my parents and most good savers. That's how it works. So most people who have become millionaires by the time they retire need to be encouraged to spend more money. And so if that's you, spend a little bit more money. Find something that'll make you happier. Find a cause you support and give away some money. And quit worrying about running out of it. You're not going to live forever, and you're almost surely not going to run out of money. If you've been managing your money so well that you were able to become a millionaire by retirement, it's not like that goes away instantly when you go into retirement. You just become this total spendthrift. It doesn't happen. You're still good at managing money. And if something bad happens, you'll be able to dial back your lifestyle just like you used to adjust your lifestyle to your income and be able to be okay.
The hosts of The White Coat Investor are not licensed accountants, attorneys, or financial advisors. This podcast is for your entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.